Hello, and welcome back to our business growth series. Today, we're focusing on a critical aspect of managing and growing your business: risk management and insurance. No matter how well you run your business, risks are inevitable. From financial challenges to unexpected events, it's essential to be prepared. In this video, we'll be covering three key areas: identifying financial risks that can impact your business, business insurance basics and the types of coverage every business should consider, and finally, how to prepare for unexpected financial events by creating an emergency fund and developing a business continuity plan. By the end of this video, you'll have a clear roadmap for protecting your business from both expected and unexpected risks. Let's get started. Lesson 1: Identifying financial risks. Common financial risks for small businesses. A list of common financial risks with corresponding images: cash flow, market risks, credit risk, operational risks, legal and regulatory risks. Let's begin by identifying some of the most common financial risks that small businesses face. Understanding these risks is the first step toward mitigating them. Cash flow issues. One of the biggest risks for small businesses is poor cash flow. Even profitable businesses can run into cash flow problems if their income doesn't align with their expenses. Example: a small cafe might have fantastic sales on weekends, but struggle to cover operating costs during the slower weekdays. Cash flow issues can arise from delayed payments, seasonal fluctuations, or unexpected expenses. To minimize this risk, it's crucial to monitor your cash flow regularly and have a cash reserve to cover those lean periods. Next, we have market risks. These are external factors like changing consumer preferences, economic downturns, or increased competition that can directly impact your business. Example: a high-end furniture store may see sales drop during a recession as consumers prioritize essential purchases. To combat market risks, diversify your products and services and stay agile. Keep an eye on market trends and be ready to adapt when necessary. Credit risk. Credit risk occurs when customers fail to pay on time or default on payments, which can lead to a serious cash crunch. Example: a small construction company that relies on large contracts might be in trouble if a key client delays payment or defaults altogether. You can reduce credit risk by performing credit checks on new customers and setting clear payment terms, such as requiring upfront deposits. Operational risk. Operational risks arise from internal failures, such as technology issues, human errors, or process inefficiencies. Example: an online store might lose thousands in sales if its e-commerce platform crashes during a busy sales season. Minimize operational risks by investing in reliable technology, employee training, and backup systems. Legal and regulatory risk. Finally, there are legal and regulatory risks. Failing to comply with laws and regulations can result in fines or lawsuits. Example: a restaurant that doesn't comply with health and safety standards might face a lawsuit if a customer gets sick. To reduce legal risks, stay up to date on industry regulations and ensure that your business follows all necessary compliance measures. Now that we've identified the risks, let's talk about how to minimize your exposure. First, diversify your revenue streams. If your business relies heavily on one product, service, or customer, you're more vulnerable if demand changes. Example: a wedding photographer could expand their offerings to include corporate event photography, providing a buffer during the slower wedding season. Next, build a cash reserve. Aim to save enough to cover 3 to 6 months of essential operating expenses. This gives you a financial cushion when revenue drops or unexpected expenses arise. Credit management is also essential. Set clear payment terms, perform credit checks on new clients, and offer incentives for early payments. Automating your invoicing process can help ensure timely payments. And of course, don't forget insurance, which we'll dive into shortly, to protect against large financial risks like lawsuits or property damage. Finally, review your financial statements regularly to spot potential problems early. Tracking your business's performance with financial metrics like gross margin or cash flow can help you make informed decisions. Business insurance basics. Essential types of business insurance: general liability, professional liability, workers' compensation, property insurance, business interruption, cyber liability. Now, let's move on to business insurance basics. Insurance protects your business from financial losses due to accidents, lawsuits, or disasters. There are several types of business insurance you should consider. General liability insurance. This is one of the most common policies for small businesses. It covers claims related to bodily injury, property damage, and legal fees if someone sues your business. Example, a customer slips and falls in your retail store, breaking their leg. General liability insurance covers the medical bills and legal costs. Professional liability insurance, also known as errors and omissions, E&O insurance, this covers claims of negligence or failure to deliver services as promised. Example, an architect makes a design error that causes delays in a construction project. The client sues for damages, and E&O insurance covers the legal fees and settlement. Workers' compensation insurance. This is required by law in most states for businesses with employees. It covers medical expenses and lost wages if an employee is injured on the job. Example, a construction worker injures their back lifting heavy materials. Workers' compensation covers their medical treatment and wage replacement during recovery. Property insurance. If you own or lease physical space, property insurance covers damage to your building, equipment, and inventory. Example, a fire damages the equipment in your office. Property insurance covers the cost of repairs and replacement. Business interruption insurance. This covers lost income and operating expenses if your business is forced to close temporarily due to a disaster. Example, a natural disaster damages your storefront, forcing you to close for 2 months. Business interruption insurance covers your lost revenue and helps you pay rent and utilities. Cyber liability insurance. As cyber threats become more common, cyber liability insurance covers data breaches and cyber attacks. Example, a hacker steals customer information from your e-commerce site. Cyber liability insurance covers the cost of notifying customers, legal fees, and credit monitoring services. Each type of insurance covers different risks, so it's important to assess what's most important for your business. Choosing the right coverage for your business. Tips for choosing coverage: assess risks, bundle policies, work with an agent. Choosing the right coverage depends on your business's specific risks. Here's how to make sure you get the protection you need. Assess your business risks. Think about the biggest risks your business faces. Do customers visit your premises? Then general liability is essential. Do you handle sensitive data? Cyber liability may be a must. Bundle your policies. Many small businesses can save money by bundling multiple policies into a business owner's policy, BOPA, which typically includes general liability, property insurance, and business interruption insurance. Work with an insurance agent. Navigating the insurance landscape can be tricky. Working with an experienced insurance agent ensures you have the right coverage and can help you avoid gaps that could leave your business vulnerable. Next, let's talk about preparing for unexpected financial events by creating an emergency fund. An emergency fund is your business's financial safety net. Start by setting a target. Calculate your essential operating expenses, like rent, payroll, and utilities, and aim to save enough to cover 3 to 6 months of those costs. Example, a cafe with monthly expenses of $10,000 should aim for an emergency fund between $30,000 and $60,000. Once you have your target, allocate a percentage of profits to your emergency fund each month. Many businesses aim for 10% to 20% of profits. Example, a tech startup with $15,000 in monthly profits allocates $2,000 per month toward its emergency fund. Finally, automate your savings. Set up an automatic transfer from your business checking account to a dedicated emergency fund savings account each month. This makes the process easier and ensures consistency. Business continuity planning. Components of a business continuity plan: risk assessment, backup systems, communication plan, remote work strategy. Finally, let's discuss business continuity planning. While an emergency fund helps with short-term financial issues, a business continuity plan, BCP, ensures your operations can continue during a major disruption, like a natural disaster or a cyber attack. Here's how to create a BCP. Risk assessment. Identify potential risks to your business, like power outages, supply chain disruptions, or cybersecurity threats, and assess their potential impact. Backup systems. Implement backup systems for data and equipment. Example, a law firm stores all client files on a secure cloud system, ensuring they can continue work even if their office is inaccessible. Communication plan. Develop a communication plan for how you'll notify employees, clients, and suppliers in case of an emergency. Example: a construction company designates a communications lead to inform clients and employees if a job site is closed due to weather. Remote work strategy. If possible, develop a plan for employees to work remotely during emergencies. Example: a marketing agency ensures that all team members have remote access to critical software and files so they can continue working from home if the office is closed. Testing your plan regularly and updating it as your business grows will ensure you're prepared for anything. To wrap up, today we covered 3 critical aspects of managing risk for your business: identifying financial risks and minimizing exposure by diversifying revenue, building cash reserves, and managing credit; understanding business insurance, including key types of coverage like general liability, professional liability, and cyber liability insurance; and finally, preparing for unexpected events by building an emergency fund and creating a business continuity plan. By taking these proactive steps, you'll be well prepared to protect your business from financial risks and disruptions. Thanks for watching, and I'll see you in the next module.